by the dawn's early light. Oh, so proudly we hailed at the twilight's last gleaming, whose broad stripes and bright stars through a perilous fight. Oh, the ramparts we walked were so gallantly streaming, and the rockets regular of our first steamer came through the night, and our flag was still there. Oh, say, does that star-spangled banner yet wave? Oh, the land of the free and the home of the brave.
Good morning, streaming live on X, Rumble, and YouTube every weekday at 8 a.m. Eastern Time. This is World HD. Today is Tuesday, September 20. Today is October 14th. Is that right? What is today's date? Let me double check. I think it is the 14th. Yeah, the 14th. Oh my gosh. Some old notes. I carried over some old notes on the debt market. And I just saw the number. Today is October 14th, Tuesday, October 14th. Debt Market Tuesday. And so what we're going to do here is, our goal in here is to look at the harmonics and figure out what's going on in the markets, and try to get a jump toward figuring out what's going on in the world, not just by listening to the news, trying to use the harmonics first. And I think we have some good cases of doing that. We've got some, I want to go through a little bit more on the stock market today. We've got the S&P. I couldn't find that chart yesterday, so now I recreated it. So we can look at that this morning. I want to look at this NASDAQ. I want to look at the Dow. I want to look at the Russell. Then we have earnings out on a couple of stocks this morning too. Goldman Sachs, JP Morgan. Take a look at those, see how stretched they are, and consider this banking sector. There's a lot to do, right? There's always a lot to do. We've got all these sectors that we have, sitting there waiting in the wings that we can go through and do that stuff. And I'm sort of getting back up to speed. We have a couple clips to run today, thanks to Rachel Hawk. She helped me get set up on a few things. I had to struggle with it last night because I couldn't get the data. I couldn't actually get the clips in to chop them up. What Rachel showed me was perfect. So we're good to go on that front. As long as I can get them in there, which I think I can now. I figured out multiple sources, because what happens is, especially with YouTube, they'll restrict you after so many times of doing something. Somehow they must pick up on the fact that you're, that you're grabbing these clips, and so I think they must restrict it. So, of course, the pros, they know how to get around this stuff very easily, but for me, it's like just one headache after another. So I think I found multiple sources to grab this stuff, and hopefully I can get quicker at it. So even in a desperation situation, I can get what we need. So anyway, all right, and then. So let's look at some of this. Let's talk about these earnings quickly. We've got, let me see. I think I have, yeah. So this is what we have today. We have some earnings coming out. JP Morgan was out this morning. Goldman Sachs was out. Wells Fargo will be out today, and Citi will be out as well. I don't think Citi and Wells Fargo are out yet. But what we have on JP Morgan is the Q3 earnings were expected to come out at 4.83. They came out at 5.07. $5.07 per share. They were expected at 483, so that was a pretty, I don't know, what is that, a 10% beat? About less than that, 8% beat, 8% over estimates. The revenues were expected at 44.9 billion. They actually came in at 47.1. So that's a pretty sizable beat on the revenues. And remember, we were talking this week about Jamie Dimon was out saying he was in Europe dealing with a lot of different things going on, right? This whole tokenization, all this stuff that's going on. Europe is sort of a playground for this tokenization, right? We have Robinhood, Vlad Tenoff over there. So now that we can do these clips, I can't wait to pull some of these clips down from Vlad Tenoff so we can start chopping into what is tokenization, you know, how does the Clarity Act and the Genius Act tie into what we're doing here? And as we see this stuff roll out around the world, all right? Okay, so, but Jamie Dimon, the CEO of JP Morgan, was out the other day saying that their AI expenditures at like $2 billion, and they're seeing about $2 billion of net benefit. Okay, so a net neutral on the AI. And maybe that's where some of this stuff could be getting eaten up in the revenues, because the revenues are actually a little bit better beat than the earnings. Okay. All right. Then Goldman Sachs, same kind of a thing, right? $11.11 where the estimates came in at $12.25. So a beat. And the revenues were expected at $14 billion. They came in at $15.2 billion. So fairly significant on that front. Both banks had better earnings. And we're going to take a look at that. I say we do it. Let's just jump in and take a look at these charts right away. And okay, so here's Goldman Sachs, and this is on a weekly chart. You can see, this starts basically around in 2015 is what we're seeing on the left-hand side. And I want to go back and just take a look at this so we can see 2008. So I remember trading this area a lot. Okay, we had a nice divergence in here. Let me just show this. So this is a good example here while we're doing this. So we had higher highs, okay, through here, and we had lower highs in these indicators down in here. Okay, so you can sort of throw this one in the mix right there, this in the mix, and this in the mix. And you see the same thing happening on this indicator. Okay, we had lower highs. Okay, so you get this lower highs, and you actually even got one on this one, right? A lower high here. Okay, with a higher high in price. So again, remember, is that right? Higher high. I think that's looks right to you guys. So higher high in price, right? Price is going higher, and the indicator going lower. So that's what we're trying to do, is measure when the thing's starting to top out. It gives us a good indication that the thing's still going up, but we're taking the derivative of that, right? We're taking the slope, and then we're trying to find the rate of change if we can. And so that's essentially what we're doing with divergence. There's lots of ways to get at it, but this is a pretty simple way, right? Higher highs in price, lower highs in indicators. And you can find a lot of indicators that'll do this. I think like stochastics will do this, MACD, moving average convergence, divergence, that will do it. RSI will probably do it too. And again, you just have to test it until you find something that works for you. At some point, like I said, when we do these educational classes, I'll go through some of that, different settings of some basic indicators that anyone can get their hands on, and how do you set that stuff up, right? So you can look for divergence as well. When you see a market, and the way I use it, I use it in conjunction with this overvalue that we've been looking at, okay? And actually, I want to show that today. I forgot. Let's do that right out of the gate. I wanted to show that as well, because yeah, we'll do that. We'll do that when we do the S&P here. Okay, so there's Goldman Sachs back in like 2008. And then what do we get? We get the real estate crisis, okay? So how does it know? That's always the question. But you see this big fall in Goldman Sachs. And what I wanted to say about this was Goldman Sachs back then, they were printing money, okay? It was literally to the point where when earnings would come out, we would see things like, like $4 estimate, and they'd come out $8, and they would beat by double. It was insane, right? Or it was really like 8 and 12. I can't remember the actual numbers, but it was just crazy. And we knew that it was you knew that it was a scam. You just didn't know when the scam was going to end. And so do we know that this AI thing is a scam or not, right? I don't think so, okay? Because there's a lot of productivity gains to be had from these large language models, these AGI, AI, whatever you want to call this stuff, right? There are huge productivity gains for those who can see like how to use it and how to really get productivity gains. I think human beings can, if they want, right, if they choose to go down this path, can see, productivity gains of 10 times what they're used to, assuming that their office, I think it's going to be pervasive. It's going to show up everywhere. And if we don't grasp it, then who is? If we don't this is the battle. You can say, well, I'm not going to do that, right? I'm just going to run off into the woods and I'm going to hide, or you can say, no, I'm going to hit this head on. And then how do you get those productivity gains? Well, it's just, you have to be committed. Like Aaron Day, he's 20 hours a day, right? He thinks he's 100 times as productive as he was a year ago. I'm not sure that that's totally accurate, but I mean, I'm not going to doubt him. I haven't seen that, but then again, he's focused on that. Like he's trying to soak out as much productivity as he possibly can. And when we have conversations about if people don't figure out how to use this, then there's going to continue to be this gap, right, between the haves and have nots. And it's sad that it has to be that way, right? We can't just live and not, it's not, everything isn't always a competition, but it seems like that's the case, right? Everything never stops becoming, especially when you're fighting the potential evil that's behind some of this, right? If we don't control it, it's the war, right? Nobody wants to go to war, right? I guess this is the 5th generation, 6th generation warfare. Nobody wants to go to war. We don't have a choice. If we don't understand it and we don't get the productivity gains out of it, the good people, right? Some good people, then it can end up in the hands of all bad people, right? And then we're under the surveillance deal and we lose our autonomy and our sovereignty and so forth, right? So I guess that's the battle, right? There's people out there battling and that's a good thing. Hopefully there's enough, right? That's the question. Okay, so back to this Goldman Sachs, right? Goldman Sachs was blowing out earnings during this real estate scam, right? Creating all these CLOs and CDOs, and all these structured things, and anybody could get a mortgage, okay? And then they bellied up, right? They were about ready to blow up. I don't think Goldman Sachs was in as much trouble as they portrayed it to be. Remember, Hank Paulson left Goldman Sachs, became Treasury Secretary. And so I don't think Goldman Sachs was in as much trouble as what they say they were. Okay. I just think they were like, look, let's make things look bad. We've got these hedges in place. We're not going to belly up, but we can still get government bailouts, right? And they did, and they took them. Okay. So that's what I think. I think they played the thing to the T as far as they could to extract as much out of the system as possible. Now, you can see that's that big sell-off, and then the market goes sideways till about COVID. We get into COVID, and sure enough, Goldman Sachs takes a big leg up, okay? Then it goes sideways for a little while into 2023, and then it takes this last leg up from late 2023 into now, right? So and you can see this one pullback in here. This was the Liberation Day pullback right there. And so this is what I want to point out is this purple shaded zone. Is there a possibility, right, that this thing will come back into here over time? It's possible. And how could we say that? Well, if I draw this, if I take this moving average here and I start to draw, okay, there's one potential projection, and maybe there, maybe there. Okay, so something like that. So you're looking at, late 2026 into 2027 potentially, if that moving average, if it's going to come back and test that moving average. And why does that matter? Well, because it also matches up with this prior area of resistance, okay, this one back in here, and this Liberation Day support, okay, that was established. Markets like to come back and test these areas. Does it guarantee it? No, but it's a possibility. And the thing with this Goldman Sachs, look how stretched it is again, right? From its moving average, from that green line. Look how stretched it is. Even look at the purple moving average right up in here. Look how stretched it is, off of that level. So very, very stretched. All right, let's take a quick look at JP Morgan. Not quite as extreme. Let me switch this over to weekly just to double check. Well, it's pretty much just as extreme. Let me clear these lines off here. Okay, there we go. It gives us a clean picture. Same kind of a thing. Okay, we've got these prior highs, right? But it didn't really come back and test as much, right? JP Morgan was stronger on the Liberation Day. It came back to its moving average, all right, better than Goldman Sachs probably did, but it never came back to retest that prior high in here. Okay, so gives us a little bit of backdrop on the big banks. Okay, Goldman Sachs, JP Morgan, both big Wall Street banker, global finance situation. All right. And the thing we talked about yesterday with JP Morgan also was this $1.5 trillion commitment, okay, to all these different industries of defense and AI and cybersecurity and all this stuff. And then that was in the morning, right? We talked about that briefly yesterday. And I'm going to dig into that because I think it's worth at some point resurfacing that. So I'm going to do some research on that here in the next couple of days. But because I think it's important because it has a sovereign wealth fund feel to it to me. Okay. It's almost like they're it just has a funny feel to me, okay? The way that they structured this thing and the way that they stated it and presented it, it just doesn't feel it doesn't feel like normal business operations to me, okay? It feels like something bigger, something global, like they're prepping for something, okay? And then later in the day they came out. So that was 1.5 trillion commitment in the morning to the U.S., right? That was U.S. directed. And then late in the day they came out, and I saw another headline where they were doing 600 billion to Europe. Okay, to the European region. So that's over $2 trillion of commitment. Again, this is a publicly traded company. And now it's almost like back to this ESG stuff where they're taking people's money and they're now committing it to these different things. And that's what they should do, right? They're sort of an asset gatherer, banker. And they should do this, but it just has a funny feel to me. Like there's something and look, JP Morgan stayed pretty clean. Back in 2008, if we went back and compared Goldman Sachs to JP Morgan, they stayed pretty clean through that whole thing. They sat and they were patient. And then they had that big debacle with the WAMU. I think it was Washington Mutual. I think that's who it was. Anyway, something was like a $30 billion company that basically degraded because of all the CDOs and CLOs that were out there to like a $2 billion company. And the Fed backstopped them. So they were able to buy a let's just call it a $20 billion entity for $2 billion. So 10% of its value. And not only that, they had the Federal Reserve backstop the whole thing. Now, once they got through the tough times, they needed JP Morgan as much as JP Morgan benefited from the whole situation, right? They needed someone to take this garbage asset off the system and put it on their balance sheet and absorb it. And that's what JP Morgan did, right? That's part of the risk you take. But at the time, the central bank was going to backstop it. The Fed was going to backstop it. And then as it unfolded, they ended up coming back and trying to extract a little bit more out of JP Morgan, and they didn't give them the backstop, but they didn't need it at that point, right? So anyway, that's kind of a relook at that, like the divergence, how this stuff builds, how it gets out of control, right? 2008. And we're seeing the same kind of a thing with these banking institutions getting a little bit out of control. And then we're seeing some odd behavior out of JP Morgan as well, like odd marketing, right? The way they're marketing this $1.5 trillion and that $600 billion, allocation it just feels a little bit out of the ordinary to me. So that's why I want to research this. Okay, that's that. Let's go ahead and take a look at these. Let's go through this stuff again. So yesterday we were looking at this S&P and I found this chart. This is what I wanted to show. This is what we were working with last week. Boy, don't tell me I can't find it again. There it is. Okay, good. All right, so this is where we were last week. All right, we were looking at, and let me put this back up there. Let's put this, there we go. And let me get that up there too for our headlines. We're going to need that in a minute. Okay. So below me is that Elliott wave thing again, right? And this is what we were looking at in this region. So we're looking at that first wave down and the potential consolidation. So let me just draw this too. I'm just going to put that underneath it. So from that one yellow oval to the yellow oval to the other big yellow oval, that's that wave one down. And we get this consolidation pattern, okay? From number 1 to number 2 underneath me. Okay, and then this is where I was thinking, okay, that there was a good shot. Yep, I know, I've got lots of drawing tools on here. This is where I was thinking where that pink box is at. I was thinking right there, that was a pretty good spot for that potential wave 2 down. Okay, we didn't get it, right? The market, we got off the show and I shorted some and then it just launched through that level, okay? Through this upward sloping trend channel, those 2 purple lines, okay? And that's what I was using to measure that 0.1 to 0.2, okay, on the Elliott wave structure. And we had energy build, right? You can see the red going inside the white. So we had what we needed, okay, and it was building. Problem is it released on the upside. Here's the thing though, okay? This thing went sideways, got up here, right? Got up, made new highs, built energy again up in this area. Okay, you can see the red going inside, the white up in there. Normally, like I said, I put that in blue. Let me just keep consistent with that. Okay, so there's the blue. Then the market sells off. Okay, then it starts following this trend channel again, which isn't, it told me that like this back in here may not have been wrong. Okay, it's just somebody came in and blew the lid off this thing to get people to start buying, right? Create panic, right? Fear of missing out. Oh, a new breakout to new highs. We got to jump in. Oh, I was short this market. I need to cover my short. So either way, you get buyers. When someone's buying back their short position, right? So think of it, they're zero. That means net neutral. They have no position. They short one. Let me double check and make sure we're still good. I might have to restart this thing. Boy, I can't tell. It looks good. Okay. Somehow I saw a disconnection on here. I don't know. And the Rumble lags, so I'm not sure that we're back. Hopefully we're back. Yeah, I think we're good. I'm just going to see here. It's a little bit of a lag. All right, if someone can just let me know that everything's back up and running. I saw it disconnect on my end, but I just want to make sure. Okay, I think we're back up. All right. Okay, so here's the thing with this. Well, I'll just have to watch this because obviously something's not great with the internet. All right, so we get this trend channel, okay, and it may not have been wrong, right? Back here. This may not have been wrong, but they wanted to get people moving one direction so they could go the other. All right. Like you do in sports or anything, you cut left to go right, right? You cut right to go left and so forth, right? You're trying to fool people. You can see this thing kind of hug this trend channel all the way through here, okay? And we get these, retests of this upward sloping trend channel. And then here's the one where we ended the show on Friday. I think it was, Friday morning. And so this was a pretty low risk short up in here, right? It's following this trend channel again. It's a prior high, so you got a double top up in here. And so I shorted a lot up in here, right? And the market starts selling off. And then it broke this 67.20, which we talked about, okay, as a first line of defense, right? Prior lows, had some memory there. Once it got below that 67.20, oh, and here, I think, is this when? So when did President Trump drop that? I think it was right around in here. Might have been, I'm not sure where that document got dropped, right? On China, right? The post. But anyway, it happened somewhere in here. And I don't think it was up here. Maybe it was up in here. Maybe this was it, right? That big push down. So I think it was there. Okay, so the market kind of was holding that trend channel. Then he drops the note on China, and then we get slammed, right? At that point, we're below this, we get that. We get the 67.20, okay? It's below that. And then at that point, that there's a good chance it's going to go back down and retest the let me see if I can find that. There's a good chance it's going to go back down and test this harmonic structure. There we go. Okay. At the white dashed line, right? So again, switching charts a little bit here. This is what we were looking at, that spot up in here. Okay. We get that come out through the news wire. Market comes under pressure. We break the 67.20, okay, which is, I think, right around in here. So it hesitates there, okay, as it should. Hesitates there, bounces a little bit, and then it proceeds lower. Okay, and then you're probably in for the retest of that harmonic structure. Okay, so I'm flipping over to this chart, right? And you can see that's that move down, that big move down on Friday. Okay, and it comes down to the white dash line, retest is 65.74. All right, so that's what I wanted to show, right? That Elliott wave. This is the problem, right? Elliott wave isn't wrong, okay, but it isn't always right either. The concept is good, okay, and when you see a drive down like we saw from the high to that 0.1, then you see that, that upward sloping trend channel, okay, the odds are that you're going to get another wave down, right? There's a decent chance you're going to get that next wave down. What you have to do is try to get in and either trade around the idea or be patient and look for that opportune spot. Now, this happens on all time frames. So this will work on dailies, weeklies, monthlies. So I'm showing you this because we can speed up time, right? I can show you this, how this went down, and then you can use this, right, over bigger swing trades, right? Daily time frames, 4 hours, weeklies, monthlies. And it happens, remember, we just showed the Goldman Sachs back in 2008 on a daily chart, right? The divergence works there. It works the same on these shorter term charts, right? These are fractals of time. So again, the concepts still work, right? Again, when you hit a baseball up, it doesn't matter whether it's a golf ball, a baseball, a basketball, or a balloon, I guess, right? It doesn't, some massive ball, right? It doesn't matter. When gravity works the same way, right? Something goes up, it starts to taper off, and then it comes down. It doesn't matter what time frame, really. I mean, there might be little discrepancies, but it doesn't matter that much. So that's what we're trying to do, is speed up time here. Now, look at where this market went to. It bounced yesterday all the way up into here. Okay, last night on some garbage news, I was up late last night working on some stuff, and I see this market take off again, and I'm like, what are they up to? Because I think, remember, let's take a look at this before I forget. Let me slide this over. We'll take a look at this. Okay, here we go. All right, so this is that S&P. So remember, this is that middle column is the daily, okay, right in here on this S&P. And we had overvalued up there, right? All that red, just like we see on this time frame, we see red, right? That's the weekly. And on this time frame, this column, we see red. This is the monthly. Okay, so what happened is we had all the red on the daily, okay, for 3 or 4 or 5 days in a row. So it was getting pretty stretched. Then on the weekly, we had it too. And on the monthly, we had it too. So we can have lots of little waves, the dailies, inside the weekly, and the weekly waves inside the monthly. It doesn't have to work that way, but it tends to work that way. There's going to be little waves inside that bigger wave, which is the monthly. And you can see what happened, right? When I ran this week, I didn't want to show this yesterday, but today's a good day to show it, is that, you know, we were at 90. You can see, I think you can see this. Anyway, that little box up in there, okay, is 90. This box here is 90. Okay, so 90% of people thought this market was going higher. At the end of last week, when the data came out Friday night, only 68% of people thought the market was going higher. Okay, so it had dropped significantly. And the daily stuff had all burned off. We actually are down at 28 now. Okay, in this daily time frame, this most recent bar right there, hopefully you can see that, where that cursor's at. That is at 28. So people went from 95% thinking the market was going higher down to 28%, literally off Friday alone. Okay, so big significant mental shift, right? And that's the thing these things can have, right? That's what can happen with this, is that you can see big mental shifts pretty quickly, right? When sentiment gets that stretched on one side, it can come back pretty quickly. All right, so let's keep rolling here. That's the S&P. If there's any questions on that, let me know. I'll come back and look at that. Let's look at the Dow. Okay, here's a Dow on a daily time frame. We had these prior highs. Okay, we tested it again. It wasn't participating with the S&P and the NASDAQ, but then it did. It finally broke through right around in here, and then it pressed up. Now it just came back with that move, and it retested this whole zone. Okay, so again, what was the ceiling may now be becoming the floor. Can the Dow make a move to 50,000? Okay, can this thing burn off this sideways, all this overvalued that we're seeing in the S&P and the NASDAQ? Here's even better. Maybe the Dow is actually going to rally, okay, and the NASDAQ and the S&P are going to take a break. That's a possibility, right? That's something to think about. And we'll stay on that. I'll come back to that as things unfold. Now, here, I want to show you this. We didn't look at this yesterday, but this is a beautiful thing, all right? So again, you know, September to December contract roll, like I said many times, I didn't handle that perfectly, but we had this, you know, on the way up, the NASDAQ, the white dashed line is 24,165. That was our full upside objective on this harmonic. It gets up, tests it, almost tests it right in here. This was back in end of July. And this one right here is middle of August. Okay. And then this one is 1st of September, right around in here. Okay. That one right there. Then it breaks through and it's off to the races. And it's looking pretty good. And you can see divergence forming, right? We talked about this. Again, same thing, right? This one even counts, right? But then this, so we're getting lower highs, okay? And the whole time up here, we're getting higher high, higher high, higher high, okay? And a higher high. So at some point, this thing's got to give up a little bit, right? I mean, something's got to give, okay? And so what do we get? We get a pullback. Where do we get a pullback to? Exactly back to the full upside harmonic. Now, people will say, well, yeah, that's just technicals, right? You know, because this, again, the ceiling up back in here 1, 2, 3 times has now become the floor. Okay, great. It doesn't really matter. This is that line in the sand, right, that we're talking about with the harmonics. The harmonic, the full energy had played out. It's now come back to retest this 24,165, and then it bounced. Okay, so even better than the S&P. The S&P pierced it by a little bit. It pierced it 65.47. The NASDAQ came right down to it. All right, now let's take a look at this on the Russell. This is the, let me go to this again. So here's the Russell on I want to look at the weekly on this. Okay, let me just switch over. Okay, here's the weekly on this thing. This is what we want to look at here. I don't know where my stuff went, but we'll just redraw it. Okay, so we've got, let me make that a little bit bigger. Not that big. Okay, here we go. All right, there we go. So I have this pink line going across the top. This is a weekly time frame. Let me spread this out a little bit. There we go. Okay. We had these prior highs up in here. Okay, this was back in 2020. This was back in 2020, March of 21. Okay, and this was November of 21. Okay, and then this is December of 24, so late 2024. Then you get that big sell-off, Liberation Day, right, in the Russell. Can't break to new lows. Okay, there's a lot of lows back in here, but it can't break them. All right, so it hangs on, okay, on this low, and then it rallies back up. Now it's sitting back up above. Now, could the Dow rally? Could the Russell rally? Could you get a barbell, right? Think of it like a barbell. You got the Dow on one side, 30 large cap stocks, and they get capital flows from outside the country. And then maybe you get Russell, right? You get this growth, manufacturing coming back to the U.S., okay? At the small and medium-sized business level, that would be the Russell 2000. And the Dow and the NASDAQ and the S&P maybe take a little bit of a break. I don't know, right? But it's fascinating to watch and see. That's why we're looking at all these different indexes. All these different indices. Okay, I think we're good on that. A couple things I wanted to talk about on this is the, let's do this because I'm going to do that here in a second. All right. So again, bank earnings, we went through the indices, we went through the S&P. I think all that stuff is good. Hopefully that makes sense. If there's any questions, I'll take a look here in a second. And then the S&P was on a 3-year anniversary on a bull market. Okay, so. And again, this is the mainstream media talking about this stuff. I think it was yesterday. It was a 3-day anniversary. And so again, this goes back into the psychology of things. And to me, it doesn't really matter that much. But what does matter, though, is that there's a 50-day moving average. One of these moving averages, okay, that's kind of trailing the market. And it got down close to it, but it didn't get there. So will it retest that level? Okay, this fits with our overvalued. We've got the daily that was overvalued, the weekly that was overvalued, the daily completely came off boil, right? Gave up all the overvalued, right, on that move down Friday. The weekly gave up some, right? It went from in the 90s down to 68. The monthly's still hanging on. We'll see what happens at the end of this month, right? We got what? We're about halfway through the 14th, October 14th, not September, like I said at the beginning. And so that's what we're going to want to watch for at the end of October. What happens with this monthly? Because this could be something that is in play for the next 1 to 3 to 6 months, maybe more, okay, potentially more. Could mean a sideways move for some of these markets. It could mean a down move too. And I hate to sound like completely useless, but it could also, these markets can move higher, for sure. Into the end of the year, they can move higher. But we have these lines in the sand, right? We have the 65.74 proved its value. We have the NASDAQ, 24,165, clearly proved its value. Hit it on the way up, came back on Friday, spiked down to it, and then that big rebound off of it. Okay, so those are good levels to manage risk off of. And I don't like the way this went down with the administration. I talked about that yesterday. I don't like the release on Friday of how they did it when the liquidity was low, when Europe was closing and Asia was closed, and the U.S. was winding down for the day, late morning, going into the midday, going into lunchtime. And then what I don't like is the way that they came back and backed off of it. All right, again, over the weekend. And what do we get? A massive gap up. So people can't participate in this. So it just feels to me like our own administration is screwing with someone. I just don't know who it is. Okay. And one of the other things I was going to say is, boy, there was something else on my mind that just slipped my mind there. Anyway, I think we'll leave it at that. A couple other things on this moving average. I did a quick search on this. It's been 114 or 115 days since we've hit this 50-day moving average in the S&P. It's the third longest stretch since 1990, okay? So it doesn't mean that we can't set new records and make the longest stretch since it hits the 50-day moving average. But it's just another way of looking at someone, I think it was Geo Rich or someone was asking the other day, how do you measure overvalued? Well, part of it is that too. Just how far is something stretched from its moving average, right? How far is it from its mean? I'm not a big fan of reversion to the mean because it can go long. It can go longer and longer and longer than you think it can. So I'm not a big fan of reversion to the mean, but you do pay attention to it when something gets that stretch. When we look at that Goldman Sachs, right, how far stretch it is from its moving averages. We look at J.P. Morgan, how far stretch it is from its moving averages. Those are the kind of things we want to watch and understand. What are they up to with this 1.5 trillion? What are they up to with this 600 billion? That's being spread around the world, right? And again, something just doesn't seem right with it. Okay, let's jump into this. I think we're good. I don't think this thing's going to work. Yeah, it's still not working. Okay, here we go. Let me go through this manually. All right, so we've got some headlines. Let's go through this. So government shutdown day 14, bank earnings underway. We talked about that. S&P 3-year bull market anniversary. Just talked about that. Average U.S. car price tops 50,000. Now, I wanted to talk about this in two different fronts. Okay, this would be a sign of inflation. Okay, and that's what we're gonna watch a couple clips today. Talking about this inflation. And again, we don't just take inflation as a one lump sum number, right? We're thinking in terms of asset inflation, demand inflation, currency inflation, okay? Because we're trying to be more sophisticated and think about this in a more logical, non-vanilla manner, right? So we have some more context out of this. Okay. Now, one of the things with this is part of this is electric vehicles, okay? The high price of these electric vehicles. So remember, like back in the day when you had landlines, right? You'd pay a lot of money for long distance phone service. And then all of a sudden it got really, really cheap, right? I mean, I was amazed. It was like, wow, that's because I was a young kid then and I different places, you're calling different family members. And I just remember, wow, this is getting pretty cheap to call people. And right after that comes a cell phone and everything goes high again, right? Now you're $1,000 a year, whatever your service is, $100 a month, $50 a month, whatever it may be. And so they took you from this thing that got really pretty good, these landlines, these analog landlines, right, that weren't digital, and they worked pretty well, right? And it was pretty stable and they got cheap. Well, that's not good, right? There's no earnings in that. So what do? They move us over to cell phones, move us onto the whole grid, right? Cell towers, all this stuff. People make fortunes off cell towers, the whole infrastructure that goes into this, and everything gets expensive again, and it's the same kind of a thing with these electric vehicles, I think, right? The combustion engine, you can make a combustion engine car for probably 20 grand, and we know how to make the engines that'll last for 300,000 miles, right? We have the history, we have the knowledge how to do this. Okay, so you can make a cheap car, and you can make one that'll last a long time, but that's not very advantageous. So what do? They come out with electric vehicles. Not only is it more expensive and is there more profit margin for people like Tesla, but you also can control, you can now have more potential control, right? If all these cars are hooked up to the grid, now you get this surveillance, okay? And there's cameras all over these cars. There's cameras. It fits with the times that we're headed into. Now, this is part of the reason that this price has been driven up to 50,000 because it doesn't need to be this. Just like the cheap, we had cheap long distance calling and then that went away, right? They took that from us and they gave us this crummy digital line, right? That wasn't clear. It's all digital. It's all muffled. Sometimes it fades away. You can't make calls and it's garbage. When the analog was beautiful, right? It worked perfect. Then you get the cell phone, high profit margin again. And that's kind of what's going on with these electric vehicles. So we can't be fooled by this. Is this inflationary or is this just technology? And is this just part of the business cycle where they screw us? You know what I mean? It's like they had something that worked perfectly fine, but no, we can't stay on that. They have to move us to something else to keep moving us forward. And you could say, oh, you're a Luddite. You know what I mean? You just don't care about advancing technology. Well, I think that there's more to it than that. So we're getting a little bit of a sell-off, I think, in these stocks. Let me flip over here so I can keep an eye on that as we're talking. Yeah, we're coming back down. So there's a good chance we're going to test this moving average, right? It's looking like we're making another run down this morning on this S&P. And maybe we'll take a look at that here in a second if this thing continues. Let me just get this up so I can monitor it while we're talking here. Okay. And then, so I just wanted to I really wanted to go through that because this is a misleading headline. Okay. because it doesn't have to be this way. I bet you could make a combustion engine car that's really good for $12,000 or $15,000, right? If that was really your target, you could get a nice little 3-cylinder or 2-cylinder and 3-cylinder engine, right? Like a little Geo. My brother had this Metro Geo or something, and he drove the heck out of that thing. It was like 300,000 miles, and it was like, it probably wouldn't stop, Now, you have to be careful in a heavy windstorm because it might blow you off the road, but that's another story. But, the point is it doesn't have to be this, okay? And this is part of the technology, part of the cycle. All right. And the other thing, the reason I want to do that is to lead into this, that I think in time, we're going to see the factories are going to become more capital intensive, meaning more money goes into them for automation, okay, and less labor intensive. So this gets us back into the Federal Reserve and the debt market, okay, and that's what we're going to focus on today is the Federal Reserve and the debt market and where they're going, right? And because their dual mandates are these two things: maximum employment and keeping inflation in check. They don't have inflation in check, and we're going to hear from a guy named Jeff Sherman at Double Line Capital. Maybe I'll just run that here in a second, where he's talking about the inflation may be coming because of these tariffs, all right? But it's not really here yet, but they suspect it is. And we can't even trust all these numbers. Remember, we're not even probably going to get the CPI data, right? I think that's due in the next day or two, maybe this week, but we're not going to probably get it because the government shut down. So hopefully that makes sense. I don't want to, these headlines are misleading if we don't keep them in context, okay? And these factory orders are the factories are going to become, they're not going to be what they once were. Even if we bring these companies back, the manufacturing back to the U.S., it's not going to be what it once was, where I don't think, right? I think it's going to be a much more automated situation, less people running the factories. I don't think this is hard to imagine for anyone. But again, it's going to be capital, right? It's going to be more about capital until people find ways to get more efficient and drive the cost down in that too. And what's going to make that happen fast? The AI. So this is almost can be a self-fulfilling prophecy where if you can really make this AI work and you can be that productive, then you can pump a lot of money into this, but you can quickly bring the cost down if that's their intent. Remember, old landlines work just fine, right? And the cost was cheap, but that wasn't good enough. They had to so if they want to, right, they can use this AI to drive costs down in factories. The question is, do they want to? Are they going to keep this cycle going where we're constantly, mice on the wheel paying for these high price things like $50,000 electric vehicles? And, China probably doesn't have a choice, right? China's making all these EVs. Now, they're also deflationary. We've talked about that. Once they got the technology to build these electric vehicles, they just built way too many, and they just flood the system, okay? And that's what's causing a lot of the problems for Europe and in China as well. We're going to get into that. Okay, so hopefully that makes sense. And there's some other things I want to talk about, but we'll save some of that stuff because I don't want to get, I can go off in the weeds on this UBI, automation, AI, robotics, and this loss of sovereignty. And we do enough of that in here already at this point in time. There may come a need to do more of it, but not at this point. Okay. Then we get into this whole China situation. This is heating up, right? We've been talking about this. This isn't unexpected. I think we're going to see this continue, and we seem to be in that zone where, okay, one more quick thing. Lumber tariffs are in place today. It's one of the tariffs continue to roll out, right? There was one thing. Okay, back to this China, all right? Oh, yeah, Hamas. I'm going to come back to that maybe. Okay, this is way out of order. All right. Let's go to this one. China is heating up, and then I'll come back and deal with this Argentina, and then we'll take a look at this Hamas. Okay, I think this is important to cover this stuff on China. Make sure we get through that today. Okay, so a couple comments out of JD Vance. I'm watching him very closely for a lot of reasons. I don't trust him, right? I hope I'm wrong, okay, but I just don't trust him. So JD Vance is out kind of playing the bad cop on China, right? Saying it's up to China now to make the next move. Okay, Beijing in return says the U.S. has the next move to relax these export controls that they just imposed. Part of this whole releasing of this data, this document or this post on Friday, and then the relaxing of it over the weekend, and then putting it back on. So this is that switch I'm talking about, right, with China. On, off, on, off, on, off. And I think we're going to continue to see this kind of stuff. Okay, so President Trump and Xi spark another standoff. Okay, and the question is here, as of Friday, it didn't look like they were going to meet at this APEC summit, right? It was looking pretty grim. And then over the weekend, they relax it. Now they're meeting at the APEC summit. And now is potentially they're not going to meet at the summit again. So this is that switch, right? I don't think this is going to stop. We just have to be prepared for this, right? And the choppy behavior that's going to come with it. Okay, so they're working in 90-day extensions, okay? And so November, I think, ends this extension. So that's probably why this thing's heating up again, right? Going into this 90-day extension that back it up, August or something, whenever that was, right? Back up, whatever this is going to end in November. I don't know what the date is, but back that up 90 days. And that's when they put this 90-day extension on, right? To open up the negotiations. So that's going to come here soon. And then if that gets extended, okay, then it's going to push that into February. All right. And if you look at some of the charts we're talking about, there's a lot of things that start to come together at the beginning of next year. Will they allow a Santa Claus rally? Will they extend this stuff, into the year end? Or will this thing, happen in November? These are the things we're watching for. And the timing on this, right? And this is where I want to tie this into the debt market, because I think I can tie this together. It's not so much what they're doing with rates. If they make another rate cut or they don't or they do, and they're probably, October is pretty much baked in, especially with the lack of data. They're almost guaranteed to cut rates in October. The question is in December, probably almost a guarantee to cut rates in December. So that means if that's the case, they're high probability of December. Especially if the market sells off a little bit, right? It's going to give them more room. Now, inflation is at highs, okay? They're not able to control inflation, and it could get worse with these tariffs, potentially, okay? And then here's what matters is this: where are they going to terminate this cycle on rate cuts, okay? And we have a signal in this bond market, and I want to show you this here on the 10-year note. But before we do that, let's take a look at let's go through these clips with what Jeff Sherman says, okay, and kind of get some context around this. Look at his opinion, because I don't agree with everything he says, but he's a very smart guy. DoubleLine's a very well-run firm that does fixed income stuff. Jeff Gundlach, smart guy. Is Jeff Sherman, smart guy, okay? And so let's hear what they have to say on this, and then we'll come back and kind of tear this apart.
Into the pieces there, what you've seen is core goods start to contribute positively to inflation again. And, over the last 15 years or so, it's primarily been a drag on inflation. And so some of that is the tariff policy coming through. And secondly, what I'd like to point out on the tariff policy is that we've seen the administration rave about how much revenue they've generated in the last 30 days or so based on the tariff policy. And so I think the run rate right now, if you analyze the monthly data, is around roughly $350 billion. And so what that tells me is that not necessarily we've had a successful policy yet, but ultimately the inventories that are being built today are predicated on this new tariff policy. And so what that is that the already announced tariffs. Now we've also seen pharmaceuticals come in the mix. We've seen recently home furnishings. Now there's the threat of China again. There's semiconductors again. So this is the ever-evolving kind of tariff roulette where no one really knows what the policy is, but we do know that we do have these baseline tariffs. And so I think it's too early to say that the inflation's been contained off of the tariff policy. And I think we're just starting to see the semblances of it. Now we're going to get third quarter earnings coming up. And unfortunately, I don't think you're going to see a lot of that tariff pricing in there yet, whether or not it's being absorbed at the margin level, where it exists in the supply chain, or if it gets passed to the end consumer. So bringing this all back together, I think the jury's still out for the next 3 to 6 months on whether or not we're going to see these inflationary impulses. And I think that also puts the Fed in a more cautious position. Though I agree with Mr. Diamond on if there's degradation in labor, they will move quickly.
Okay, so hopefully that ties in nicely with what we were talking about, right? This idea that President Trump, Scott Bessent, Lutnick say there isn't going to be a transfer through in inflation to the consumer. And again, why does the consumer matter? Because it's 60 to 80% of the U.S. economy. Okay, it depends on how you measure it, but it's a lot. And so back to the EVs, back to the lumber tariffs, right? Back to China. Okay, this is what we're going to get into with China now too, is in thinking about this 10-year note and what's going on. We could spend hours on this talking about this, but I guess the big takeaway is this. Will President Trump and his team be right that these tariffs will not be inflationary, or will someone like this Jeff Sherman and Wall Street be right that this will ultimately trickle through? Okay. We don't want to be fooled by the EVs being 50,000 because that's a false read on inflation. Okay, that's the kind of stuff we want to avoid. We want to watch and see what happens with these lumber tariffs, right? And then what we want to do is let's dig in here and see what's going on with China. Okay, so Scott Bessent was out yesterday saying that he's accusing China of trying to hurt the U.S. economy, okay, and damage the global economy. All right, now how are they doing this? They're saying that Bessent was saying that China's economy is so weak, okay, that they want to drag everyone else down with them, okay? This fits into inflation, all right? And here's why. Because China is a provider of a lot of goods around the world, especially now these rare earth minerals and materials, okay, and the magnets and so forth. So China is really now doubling down on the regulation of exports of these rare earth minerals, not just on the U.S., but other major players around the world. So they're playing hardball, okay? And the question is, will this escalate to the point where Trump and Xi don't meet? Okay. And what does that mean for the stock market? Potentially a sell off. What does that mean for the dollar? Potentially it goes higher. Okay. The dollar is a funny thing. It tends to do really well when things are really good and things are really bad, right? And it tends to drift lower when things are not good. Now, this Jeff Sherman talks about the dollar in this next clip. So let's go ahead and hit this one. And then we'll come back and talk about this because I don't agree with him on this. I think there's things he's missing. But again, very smart guy and worth listening to his opinion on this.
When I look at the debasement trade, what I also look at is the 30-year bonds across the developed world. And what you've seen there is really a rejection of investors trying to step into that, even when there's this perception of a Fed cutting cycle. And so I think the idea that the policies here are not really U.S. friendly, they're not dollar friendly. And if we're going to continue to kind of put pressure on the dollar, it's going to put some inflation in the U.S. as well. But the developed world suffers from a fiscal overspending, and that's what's being reflected as well. And so I think the debasement trades make a lot of sense here. Granted, they have a lot of momentum at this stage. And as you mentioned silver in there, silver hadn't been part of the discussion until the last few weeks. But ultimately, I think there's a lot of investors looking around saying maybe the strength of the U.S. dollar has been overdone. And by the way, the dollar has been overvalued, whether you look at real effective exchange rates, trade-weighted basis, purchasing power parity. It's been overvalued for almost a decade now. So probably it's time to get some more stability in there and bring the dollar down. And I think that's what you're seeing reflected there.
Okay. So this can pull something, if I can do this right, this will pull some things together. So again, the other day someone was asking about what does overvalued mean, okay? And so there he gives you his example, right? Dollar purchasing power parity, this, that, whatever, right? They're using all these metrics to value the dollar, okay? And the dollar, the currency relates to the debt market, okay? And we can't forget sight of that because again, we're going to talk a little bit here after we get done with this China, we're going to talk about Japan and France. And their issues with their currency and their debt, okay? Japan's issues are totally different than Europe's. Europe's is different because they have one currency, multiple debt markets. All right, but back to the U.S., back to China. He's talking about the dollar and saying that it's overvalued. It's been overvalued for 10 years, okay? And he's looking at certain metrics. I look at it by saying this. China's been a big purchaser of U.S. treasuries, and so is Japan. And so have other people around the world. We now have Milei, okay, of Argentina in D.C. today. Okay, we talked about the swap line last week, right? The U.S. creating the swap line with Argentina. Why, right? Argentina needs to be pegged to, in some way, they need to be tethered, okay, to the U.S. because if not, their currency can slip away. If they get tethered to the U.S. through a swap line, through debt, currency, and so forth, they sort of protect themselves because now the U.S. dollar, if it goes up, right, they're connected to it and they don't have currency inflation, okay? So when Jeff Sherman says the dollar is overvalued, relative to what? Relative to desperation. If people get desperate for U.S. dollars because there's so much debt out there in the world and they have to pay back this debt in dollars, because again, the dollar is the world reserve currencies. There's lots and lots of dollars out in the world, but maybe there's not enough. Okay. So is gold overvalued, right? I can show you a chart that makes this thing look so overvalued, right? Is JP Morgan overvalued? Is Goldman Sachs overvalued, right? Are all these things, is the stock market overvalued, right? They're only overvalued when people get done selling, when the momentum shifts, right? When we get divergence, when these things start to roll over, this is why the stories, the BS that comes out of the mainstream media is mostly that. It's BS because they'll say, oh, it's overvalued, it's overvalued, it's overvalued. They don't really define what does that mean, okay? And they don't back it up. They don't explain like, well, on what time frame. Like that's why I like to do daily and weekly and monthly and look at these different time frames because I can say, well, it's overvalued on the daily. What does that mean? When it came back down to those harmonic levels in the S&P, right? 65.47, 24.165. Does that mean that it's now not overvalued? Does that mean that it's now fairly valued because it's back at a balance point, right? Again, I think there's things going on out there that are natural, okay? And even though people try to manipulate this stuff, they can't manipulate it that much. All right, so back to China. China's trying to manipulate this trade deal with the U.S., and so is President Trump, back and forth. Okay, so the Australian dollar has been in our mind too. I talked about that yesterday, right? What does that have to do with anything? Well, we've seen the U.S. has now been creating these sovereign wealth, this potential sovereign wealth fund, right? They talked about it early in the administration. They haven't talked about it much, but they've been taking actions by putting things in there. Lithium Americas, right? Stake in Intel. Right, a stake in this trilogy, which they did last week. And now we're starting to see these rare earth metal companies all over the world starting to get a bid in them. Okay, they're starting to be bid up. People are coming in and buying them with the idea that what? The governments are going to come in and take a stake in them. So now we're seeing this happen in Australia. Okay, they're coming in and there's a lot of critical mineral companies in Australia. Australia is connected to China. Okay, and this is how, right? Everybody wants these rare earth metals and they're going to start running them down, right? Greenland, South America, Argentina, right? It's a battle for this stuff, right? For this new world that we're going into of high tech, right? Again, back from the phone lines that were analog to these, to this digital world, okay, where they can control everything, right? Because this is moving toward control. So China's hitting back in any way that they can. Okay, Besant's saying that they're very weak, all right, and that they're trying to take the world down with them. And that does kind of make sense, right? I think that and who is China? Okay. Who ultimately is China? Is China our own neocon? Is it our own deep state? Is that who's really, they've been paid off. Like how distantly connected is our deep state from China, right? How much money do they receive back and forth? Like we can only imagine. So what is China really? And what is China's leadership? It's President Xi and the People's Bank of China, and then they consolidate the stuff, and then they try to fight back with low price goods around the world, right, that are deflationary overall. They sell the U.S. Treasury market, right? They try to exert their will as much as they can. The problem is they have a garbage currency and nobody cares about it. Nobody will transact in it, and they're the only ones that really hold their own debt. No one else, and we've talked about no foreign direct investment going into China as well, okay? It's coming into the U.S. So there's a lot of factors in play here, but China's doing everything they can. Scott Bessent saying China's playing, they're trying to destroy, they're so weak that they're trying to destroy everyone else, okay, with what they have, and that is what? Rare earth metals, rare earth minerals. The U.S. is coming back with other things, okay? We're coming back and saying, well, these chips, right? And so what I want to do is simplify this, okay? There's all kinds of fights over shipping, okay? South Korea's building ships, China's building ships. The U.S. isn't very good at building ships anymore, right? We lost that skill set. So now there's this battle going on, right? China's trying to exert its will with the shipping, not only shipbuilding, but also bringing ships into the ports, okay? So everybody's trying to exert their will. And this is what's going to happen with this China-U.S. thing. It's going to be this lights on, lights off, switch on and off, on and off, on and off. And I think each side's going to keep trying to exert its will. If the U.S. didn't have so much debt, we wouldn't have to play this game, okay? But we're very susceptible to the debt markets and loss of faith in our system, loss of faith in our currency, loss of faith in our debt, our ability to repay that debt. We're very susceptible. So is the rest of the world, right? So are so many other major global economies. Okay, so hopefully that wraps things up with China. There's lots of things we could talk about, right? There's going to be battles. This is not going to go away, right? They're fighting over a lot of different things. And here, let me simplify this, right? We can watch soybeans, all right? And I didn't really plan to look at this, but let's just take a look at it real fast because soybeans don't look good. And I know it sounds like we're all over the place, right? But soybeans are part of this negotiation process, okay? And so everybody's going to focus on Intel and these chips and the shipping and the crude oil coming out of Russia, going to India, going to China, and we'll cover that tomorrow, right? The energy side of this. So everybody wants to make this really complicated, right? But I think you can make it really simple. We can just look at soybeans, right? Because soybeans were part of Trump 1.0. We know that South America is, I don't think I mentioned this yesterday, right? That the soybean usage in China is at record highs. And yet China's purchasing no soybeans from the US. So that tells you that this agricultural space is probably more important than what they'll lead on. And no one will tell you this, right? But the point is, if soybeans start to recover, then maybe we're a trade truce or some negotiated deal is starting to develop between the US and China. Why? Because that's going to be a negotiating factor for the US farmer. President Trump's going to say, we need China to buy these soybeans, right, to strengthen our economy, strengthen our farmer. Right now, soybeans look pretty grim. Okay, we have this harmonic structure in it, but let me just pull this up. Let's take a look at this. So I think this is the way we can take a lot of this complication and make it very simple. And just watch soybeans, not get caught by the lights on, lights off, lights on, lights off, right? Flipping the switch. Okay, so lost my mouse again here. Let's take a look at this. I think it's this one. There we go. Okay, so let's take a look at that. And this will be quick, right? It's pretty easy. Here's the soybean market, and this is our halfway harmonic in this. Okay, we had this breakout zone, right? The pink shaded zone came down to the halfway down in here. Okay, broke through it. I need to mark the rest of the stuff. So the dark green line is the halfway harmonic. Let me just throw this in here too, just for a little bit of, actually I need to upgrade that, make it better. So again, the pink shaded zone's a breakout zone. We have the dark green line is a halfway on this harmonic. And so you could just double that from the bottom of the pink breakout zone, take the green and then dark green and then project it down below. So we're not close to that and we're hanging out below the halfway. So this tells me, okay, that this deal's not close. This is going to be lights on, lights off for quite some time. It's going to be shipping. It's going to be rare earth metals. It's going to be, EVs. It's going to be this, that, every crude oil out of Russia. It's going to be all these different things. But I think one of the major components in this that isn't being talked about, it does hit the headlines, but no one really, highlights it or puts a light on it, is the soybeans. So if these soybeans go down to the full downside objective, that's where I would be looking to say, and this gets crazy, right? Because you're like, what? We're going to use these. This is the key to the harmonics though, right? We've seen this in all these markets we've looked at, the crude oil, the stock markets, right? The silver, right? What else have we looked at with these? The point is, if these soybeans get down to the full downside objective, at that point in time, I might be willing to say, are they getting to a truce, right? Are they going to get a negotiation in place that's good? And can these soybeans rebound? In the meantime, we'll just watch this halfway harmonic at 1,011. Okay, the dark green line. If it stays below there's a good chance it's going down to the full downside objective. If it pops above, right, it's our line in the sand. If it pops above there, then we can think that there's a trade deal underway. Okay, and why does this matter? Now let's take a look at the treasuries. Hopefully this is going to come together for everyone, because I know it's like it feels scattered. I think, because there's a lot of things we're taking everything, right? We're taking the currency, the debt, not really so much energy, but then that commodities, agriculture, and trying to pull all this stuff together, because that's what this trade deal with China will involve. It won't just be about chips, right? AI chips. It won't just be about rare earth metals and minerals. It won't just be about cheap goods coming out of China, right? It will also have an agricultural component, because for two reasons. One, to protect our farmer. The other reason is to take away the power from China. Okay, if we win this negotiation, if China's at all-time highs of purchases of soybeans, okay, and they and they're not buying any from us, then they're exerting their pressure around the world by buying soybeans from someone else. Where's that? Mostly out of South America for the soybeans. I think, right? I think that's, and so they're exerting will down there. So our Milei coming to the Oval Office today, talk about the swap line, try to create, where are you going to go? You're going to try to create a friend down there. The easiest place to make a friend is with Argentina and Milei. Okay. Then you try to spread that out, right? You try to creep, into Chile, right? Up into Brazil, maybe into, other places, Venezuela potentially in time. Okay. So let's take a look at this 10-year note. We've got a couple things going on in here. Let me, this is the bigger picture. This is that monthly on the 10-year note. And and so this is, back in early 1990s back in here, right? So let me just mark that big. Okay, so this is the early 1990s. So we're looking at a monthly chart on this. The trend was up, got up in here during COVID, right? Up in this area, right in the middle of that trend channel, and got slammed off of it. Okay, now we're just we're down in this area, down around this white dashed line, okay, this line in the sand, and we're sort of consolidating around there. The question is, can this thing make a move back up into this orange zone? It would make sense because here's a prior low, okay? There's a couple prior lows back in here. You got a prior high right here, okay? So you got a couple things going on in this area. So it would be quite likely that this 10-year note would make a rally back up into that orange. All right, so let's break this down. Let's take a look at the daily. We have a harmonic signal in this, okay? And I'm going to let's go to this one. This will be better. Okay. We have a couple prior highs, right? Back in here. This 114.19 back in here, all right? And this is also where this harmonic structure projects to. All right, 114.19. I'll break that down here in a second. On Friday, right, this 10-year note's been locked up. We've been covering this thing. You can just see this thing's been hugging this red line down in here, the whole time we've been doing this show, okay? 10 years just been hanging around in there, and you can see it's building energy, this blue box, right? The red's going inside the white, and it's been hugging the bottom end of this. So it's struggling, right? Because you can see this isn't the traditional pattern of this, right? It broke down, it hit this, it rallied up to this trend channel, top, went down, came back up, right up into here, came back down, and then it's been just hugging this thing really since, early 20, well, this year, early 2025. Yeah, so late last year, December of last year, early this year. So really for 10 months now, 10 to 11 months, almost a year, this thing's just been hugging this trend channel. Can this thing make a move to the upside? It did make a move on Friday. When the stock market sold off, this thing did get a little bit of life. There was some volume that came into it. It started to press to these new highs, right? It's pressing on these prior highs back in here, right? And so let's look at this harmonic structure on this thing. All right, here's the current harmonic structure. Came in back here, right, where that purple dot's at. Right back in here. Okay, this was on September 30th. And this is the breakout zone, the energy buildup zone. So you can see it's traded through there a couple times. And I've marked a few of the spots with these yellow dots. A few of the points where it's reacted to the harmonic structure with these yellow dots. Okay. And now we see this thing making its way toward the halfway. All right, now let's also look at this. All right, here's an old harmonic structure, right, that we've been watching for quite some time. And another old residual at 113.18. So there's a couple things lining up where that white dash line's at. Okay, this is a different white dash line that's on the daily, right? That one's at 111.10. This one's at 113.18. So we're introducing a couple different levels. But the reason we're doing that is because if we can crest this 113.20 area, okay, which is the halfway, right, on this new signal, this dark green line, okay, then there's a lot of potential upside, all right? And the upside's been opened up now, right? We've cleared some heavy, heavy levels, right, that this market has a history with, and harmonically, right, just structurally. And this market, we know it's built a lot of energy. Sometimes I question if maybe they tried to crash the market on Friday just to get, a one-day crash, right, just to get some fear in the market, to have people come into this 10-year note. I don't know why they're doing it, right? You can be very skeptical and negative about it, or you can say, like, are they using the stock market potentially to pump this thing, right? Literally like an air pump, right? You're just kind of pumping this 10-year note. Why do they need that? Because the lower rates we can lock in, the better it is for the deficits we have, all right? So that's a lot of things to swallow there. We covered a lot of ground today, right? Hopefully, I think for people who've been watching the show, hopefully we're connecting some dots. For people who haven't, it's probably a lot, right? But the point is, can this 10-year note, to make it simple, we're watching the soybeans. Is there a deal to be had there? It should give us some indication. We have a harmonic structure there. I don't think it's disconnected from this 10-year note, right? That's what I'm trying to do, is draw a connection between these markets, right? If there's a deal to be had with China, I think it's going to involve soybeans. If there's a deal to be had, right, for this administration with China, but also just on a global front, a lot of it's going to come down to lower interest rates, all right? Stephen Moran's been talking about that. President Trump's been calling for that for a long time. That's why he's put so much pressure on the Fed. That's why we're going to get a new Fed chairman, not Jay Powell. He's on his way out. They're going to, probably in the next 2 to 3 weeks, they'll be announcing who the next Fed chair is, okay? And with that, what's going to be the reaction of that, right? Will that help in this move, right? Will the selection of Kevin Warsh or Kevin Hassett help this market finish, this 10-year note finish its harmonic structure on the upside? So that's what we're watching on this 113.20, right? This dark green line. Can the 10-year note climb above that? If it does, there's a good chance it's going to press much higher. And where is that? Okay. It could be a break. So this green line is that full upside objective. All right. That will be the full upside objective on that harmonic structure we're just looking at. If it can get above that 114.20, then maybe, just maybe, right, we are looking at something that can cross this trend channel. Now, I'm not holding out a whole lot of hope for that anymore. I'm just thinking, like, can we see something up in this area? All right. Maybe something like this, right? Some kind of something takes out these highs. And will it be sustained? And this is where I started off the show with, it's not so much if they cut rates when, in October, in December, it's more about the termination of this cycle. Where are they going to end this cycle? Inflation's high. Is it going to trickle through? Okay. That's what Jeff Sherman's talking about. The dollar's overvalued. I'm not sure I agree with that, right? And hopefully this, at least, if nothing else, it stirs a lot of stuff up in your mind where you can say, okay, all these smart people are saying the dollar is overvalued, right? The question is it, right? On what metric? What metric are you using? It's not overvalued to Malay in Argentina, right? Like, he wants more and more dollars, right? Because why? He wants that swap line. So it's not overvalued to him. How many other countries out there are as desperate as Malay and they want more dollars? They just can't admit that they want more dollars. If that's the case, then this dollar is not overvalued, right? And that takes us back to that whole thing. And I'll come and look at that real quickly. This is that dollar. Can this dollar hold this area, and can it come back up and retest this high, this 120 area? Okay. It would create panic. We looked at the Australian dollar. We've looked at the British pound. We've looked at the Canadian dollar. We looked at all these other currencies that have a lot of energy building up, and they look weak. Okay. And we'll keep coming back to these things, right? Trying to connect Australia. All these markets, I hope this is the one thing. When we start crossing all these different disciplines of currency to debt to stocks to energy to commodities, these markets are not disconnected. And that's one of the things I hope people can take away from today, is that I think this soybean has a connection somehow to this 10-year note, right? We have harmonic structures in both of them. We can see what they're up to, right? This deal with China and trying to get our debt down, right? These are the two of the probably biggest central focus points of this administration, right? How do they take away the control of China in South America, right? In Europe, in Asia? What levers can they pull? And getting this debt down so that we can restructure this debt for the longer term. And then we open up all kinds of cans of worms, right? With tokenization and all this stuff, which is definitely not a discussion for today. Okay, so a couple things. Let me circle back. Malay's in DC today. We talked about that and why that matters. This wrap up on Hamas. I mean, look, I hope, and then we'll come. I do have to hit this, France, and just an update on that real quickly. Look, I hope that this Hamas thing is positive, but I heard a comment yesterday called mowing the grass, and it's pretty negative sounding where, is Israel done? The quote was, is Israel done mowing the grass? And what that means is that they bomb, and then they bomb, and then they bomb, and then they let it grow back up again, and then they bomb. So it's like mowing the grass, right? They just go through. And if you look at what that whole region looks like, and you look at parts of Syria, I mean, it's just absolute devastation. And it's sort of an accurate comment, but it's also very discouraging, that is this just mowing the grass, right? They mow it down, and then they let it build back up again a little bit, and then they attack it. Is that changing? Is that region around Gaza and the Palestinians and Hamas and Israel, is that going to change? I don't know. Okay. But I just wanted to put a cap on that, because that'll probably be the last I talk about this for a while. Unless it relates to the energy. Okay. Unless it relates back to the energy. All right. And then two more quick things. France. I lumped these two together. Let me see here. Okay. We're packing a lot in today. So Japan and France woes continue. Let me see if that'll go away. Okay. The prime minister in France, it's been a train wreck. He's back in action. Thought he was gone, came back Friday, appointed a new cabinet. Okay. And now the big deal here is the real contentious point is suspending the pension reform that they passed in 2023. Okay, so extending the retirement age from 62 to 64. And there were protests in the street over this, right? Le Cornu, the prime minister that was and now is again, wasn't and then is again. Is he going to be able to navigate this? Okay, people are disgusted with Macron right now for multiple reasons. This one probably first and foremost, taking away holidays. We've talked about that, right? I mean, they're looking anything they can do to try to salvage this economy. Wealth taxes is probably going to come up soon. Not looking good. Continued train wreck, watching it evolve. This is a mess. I don't think they can navigate this very cleanly. This might be why the euro comes down, okay? Because again, this thing's starting to crack. There's rumors out there. I've seen things, but I haven't studied it enough that Italy is saying they want out of the euro, okay? If you get France causing issues and you get Italy saying they want out, okay, this euro is in big trouble. Okay, so is the dollar overvalued, like this Jeff Sherman says? Not if you're looking at it that way, right? Again, if the euro is the biggest thing on the other side and the dollar is, the euro goes down, the dollar goes up, right? That's the biggest weighting on the other side of that teeter-totter we talk about. I'm not so sure that it's overvalued. And do other countries want the dollar? Because as this thing unravels, can the dollar will fail, right? I think ultimately technology and just the amount of debt that we have will cause the dollar to fail. The question is, does it fail on the upside, right? That's the thing I've been questioning and trying to make a case for quite some time, right? And there's hardly anybody that's in that camp. Here's a smart guy saying that it's overvalued. It's been that way for 10 years. And he's not, I don't think he's thinking about all the things in the right way. But again, smart guy, can't discount that. Have to at least give him the attention that he deserves. All right. The other thing is Japan, train wreck there too. We saw this Sane Takaichi come in 2 weeks ago or less in the LDP, the Liberal Democratic Party, and already they're trying to the other parties are trying to unite against this ruling party, the LDP. So this could oust this newly elected Sane Takaichi before she ever even really gets a shot. Okay, this Parliament would have to approve her by the end of the month. President Trump has a meeting scheduled to go there. Would this derail that meeting too? There's a lot of issues in this Asian region because China's exerting its will all the way up into islands near Japan, all the way down, putting pressure on Taiwan. This isn't a good thing from a defense standpoint, okay? And will this end Takaichi's successful win before it really even gets started? So that's the big question. All right, so that wraps up France and Japan. Two major economies, need to pay attention to them. Lots of impact, right? Lots of impact with what goes on with Japan. Is Japan weak? Does that allow China to make a move? Is France weak? Does that spill over to Italy and cause issues for this euro and pushes this dollar higher? And what does that do for the treasury market, the U.S. treasury market? How does it finish this harmonic, right? And watching the soybeans to see, is this trade deal making any progress with China? If it is, I think we're going to see soybeans hit the full downside objective or pop back through that halfway. So hopefully that makes sense. Hopefully I pulled all that stuff together because that was a lot today. And with that, I think that wraps it up for us. I think we've hit everything. The 10-year note, we hit that. We hit those. I think we're good. All right. So with that, tomorrow's Energy Day. I think it'll be simple, right? I don't think, again, you never know what can happen today, but I think Energy Day will be pretty simple for us tomorrow. We'll take a look at the crude oil, the natural gas, maybe dig into some things on the small nuclear reactors now that I have the ability to create these clips again. I'll pull some stuff off on Oklo and a few others and see if we can't dive into that a little bit on the energy front. All right. With that, have a great day, everyone. Have a blessed day. We'll see you tomorrow. Thank you.